Hello guys, you are welcome to module 3 of this basic 4. In this module, we are going to concentrate on risk management. In Forex, risk management is very important, so it cannot be overemphasized. You hear people talking about manage your risk or Forex is risky, you are going to lose your money and the rest. When they say Forex is risky, they are referring to risk management. How do you manage your risk so that you don't lose more money in the market? That's what is important in trading. So it's not about how much you make in a particular trade. It's about how are you able to manage your risk so that you don't lose more money. Because you can enter a trade now and make $100 with poor risk management. You repeat that same process again. The same poor risk management you used, when you make any small mistake in trading, it's going to cost you a lot. It may even wipe your account. It may even wipe your account and lead you to losing more money and throw you off psychologically. So what we are going to focus on, how do you manage your risk? How do you keep your psychology intact so that you keep trading and making profit in the market? So in this our class, if you encounter any issue or have difficulty in understanding anything, just send an email to collinsalumeze@gmail.com. So let's look at risk management. I'm trying as much as possible to keep this class very simple and smart. That's using the personal method I call KISS. Keep it simple and smart. So to keep it simple, we are going to start with lot size. Lot size, like I said before, is what determines how much you are going to make in the market or how much you lose in the market. Some persons call it greed button, in the sense that it is a determinant of what you get and what you lose. It is also called volume. That's how big you buy a particular currency or how small you buy a particular currency. This is just like purchasing power. You want to buy something, you go to the market and you see an iPhone or you see bags of rice. So when you see a bag of rice, you can decide to say, okay, this bag of rice, you are selling it relatively low. I want to buy 3 cups of rice. And the vendor will sell you 3 cups of rice. The vendor now refers to what your broker, the broker you are using. So you can say, okay, the price of this is fine. I want to buy 3 cups of rice, or I want to buy 10 cups of rice, or I want to buy 1 bag of rice. So the measurement, the volume at which you buy a particular currency is what is referred to as lot size. The same thing happens in foreign exchange trading. You can see a currency doing well, maybe USD CAD that is performing well, the price is so low, and you say, okay, by buying at this place, I'm confident that the price will increase from this and go to this place. And if it increase from this to this place, I'm going to make like 10 pips, 20 pips, or 50 pips or more. So since I'm going to make 10 pips, 20 pips, or 50 pips, I think I need to buy at this price and buy with this lot size. So you can say I want to buy big or I want to buy small. So how big or how small you are going to buy a particular currency is what is referred to as lot size. So I can say, okay, I want to buy with 0.10 lot size, or I want to buy with 1 standard lot, I want to buy with 5 lot size, or I want to buy with 0.01, which is a micro lot. So that's how lot size is. Lot size signifies how big or small you want to buy a specific currency. And then it's measured in what? Units. A unit of a pip is 10. So we have 3 types of lot size, which we are going to treat now. The 3 types of lot size we have is the standard lot size, the mini lot size, and the micro lot size. So when we are talking about the standard lot size ranges from 1 to infinity. It doesn't have range. It starts from 1 to infinity. You can use 1 standard lot, you can use 2 standard lot, 10 standard lot, 50 standard lot, 100 standard lot, and so on and so forth. So we also have what we refer to as mini lot size. Mini lot size starts from 0.10 to 0.99. So that's what we refer to as the mini lot size. We also have what we refer to as the micro lot size. The micro lot size ranges from 0.01 to 0.09. So that is the micro lot size. As we progress in this class, I'm going to teach you when and the account that is suitable to use each lot size. So when we are talking about forex and currency trading and risk management, as the case may be, we are talking about what the long-term view of trading. How do you continue to trade in order to be in the market without losing your capital? That's our focus, and not how do you trade to make a particular money now, that after making this money tomorrow you will lose the money because of your poor risk management. So that is not trading. Trading is what? Little accumulation of money that leads to generation of wealth. You are trading little by little. You make small money today. You say, okay, I made $3 today. Tomorrow you'll be able to still make the same amount of money, and the day after tomorrow you still be able to make the same amount of money without losing your capital. Not the one that you make $100 today, tomorrow you lose $200, the next day you are making $500, another day you are losing $1,000. So that is not trading. It is one step forward and two steps backward. You keep on limping at the same place. So let me show you how and what a trading plan looks like, so that you will see that this journey of risk management is a journey to wealth building, a journey to step-by-step successful accumulation of wealth. All right. So here is an example of a trading plan. So this is a trading plan that is drafted to last for what? A year trading plan. So when you look at this trading plan, you will see you can also use the format of this trading plan. You can write the dates here, the dates that you'll be trading, or you can write the days that you will trade. Maybe, okay, these are the days you'll be trading, these are the dates of this thing you are trading plan, the journal here. So this is the combined lot size. So in this lot size, it shows you how your lot size grows from one stage to the other. So this is the pips that is needed. You trade, you make a certain amount of pip, you go out of the market. When you come back another time, you make a certain amount of pip, you go out of the market. So not trying to use all your lot size to make all the money in the trading, the forex market once. No. So this is your startup capital. Let me say you start with a $250 and you are able to trade that $250. You see, by growing it gradually, where the $250 will lead you. So here is the new account balance. So let's say in the first day you are able to trade this $250 account and you traded with 0.03 lot size. That's a very small lot size to it. You were able to make 50 pips, and that your 50 pips, it will be converted to what? $15. So that 50 pips will give you $15. Then your new account balance is what? $265. Another day you are able to trade with 0.03 again and you made 50 pips again. 50 pips will give you $15 and your new accumulated balance is $280. You trade the third day again. The third day you using 0.03, making 50 pips again, which is $15. Your account is gradually growing. So when you keep trading, you see in the 8th day, that's the next week of your trading plan, you are able to trade with 0.04 because your equity has what? Increased. What we call equity, we refer to as equity, is the capital in your trading account. So your equity has increased from what? From 200 to 500 to 355. So in this 355, that's what now made you to increase your lot size to 0.04 in trading. So making this 50 pips, it will now be what? $20. So $20 added to your current your equity is now 375. So if you continue to trade small gradually, you may not notice it, but let me show you the power of this risk management and compounding. So the power of this risk management is in the 28th days, or let me say the 20th day, which is 1 month trading days. You are now using 0.06 and you make 50 pips. So in that 50 pips, you are able to make $30. That $30 will give you what? Plus that $30 added to your profit, your equity will now give you 675. So in the second month, which is 40 days of it, let me see the 40 days as the second month. So in this second month, you are able to be using 0.17 lot size, which is what your this thing can carry. So you make $85. That $85 added to your equity is 1,800 what dollar. So you see the way your equity of 250 keeps growing, because you are using a minimum risk management that is suitable to the account that you have. It is suitable to the account that you have, and you are managing your risk well. So let me show you what happens in the third month now, or in the fourth month. This is a gradual process like I explained to you. Now, okay, let's say the fifth month should be the 60th day. So the fifth month now, you are now using 0.45 lot size, and you made 50 pips again. The 50 pips will give you 225 USD. So that your 225 USD added to your new equity now will now be $4,770. So you see how you are growing your money gradually, without jumping to trade and make all the money once. That you trade today, you lose tomorrow, and you keep on growing your equity. So your equity grows gradually till the point you are using the 73 days. You are now using 0.86 what lot size and making 50 pips. So the 50 pips you made, you are getting over 9,000 USD. So that is what I refer to as what risk management. If you are managing your risk very well, this doesn't mean that you will not have what losses. Days will come when you will have losses, but using this trading plan as your guide will make you not to have losses that will wipe your account. It will always keep you in shake, that any day you don't make money, there's another day for you to make money. Not trading with trading without being psychologically balanced, and then with the fear that you lost money that day, you don't make money another day, you keep on clicking buy, sell, and the rest of them. One trade at a time, one growth at a time. You keep on trading your strategy, which I'm going to teach you here, and a lot of things that will make you to make money from the market consistently. So any day that you lose money, you know that is a day gone. So if in the 80th day you are able to be using 1.21 lot size and you are making 50 pips, your equity is now 12,670 US dollar. You may not necessarily have this 12,670 US dollar, but at least you'll be close to it. You'll be close to it, because this is now a compass. Maybe you're having losses and the rest of them. So if you don't have this $12,600, $670, you can have what? $9,000 or $7,000. It is still a win-win game. It is still a win-win game from the business you started with $250. So you see that it's an accumulation of what? Wealth over time. You are not rushing anywhere. That's why I say the forex market is where those who are impatient come to dash money to those who are what? Patient enough to wait for the market to react to a particular setup. So let's continue with what we are talking about in risk management. All right, guys, we are now going to look at, okay, the lot size that is suitable, that when you use this lot size, you now know the number of pips and the units and the amount that you are going to what to get. So to get a particular unit, we say that a unit of a pip is 10. So if you want to know, if you want to know what you will get when you use 0.01 lot size and you make a particular pip, maybe your trade moves to 10 pips or to 50 pips or to 20 pips, how much you will make from the market. So what you will do is you will check the unit of pip of you check the unit of the pip. So let me say your trade did 10 pips. You say, okay, a unit of a pip is 10. Since a unit of a pip is 10, what you will just do is what? 10 pips multiplied by what? By 10. Because the unit of a pip is 10. 10 pip multiplied by 10 will give you what? 100 units. So a unit of a pip is what? 10. If your trade does 20 pips, you now say 20 multiplied by what? 10, which is a unit of a pip, that will give you what? 20 units. That means your trade did what? 20 units. If your trade did 25 units, you now say 25 multiplied by 10 will give you 250. That means your trade did what? 250 units. Let me say if your trade did 65 pips, that means your trade did 65 multiplied by 10, because a unit of a pip is 10 multiplied by 10. That will give you 650 pips. If your trade did 30 pips, you now say 30 multiplied by what? 10 will give you what? 300 units. That means your trade did what? 300 units. If you made 10 pips in a trade, that means your trade did what? 100 units, because a unit of a pip is 10. You now say 10 multiplied by what? By 10, that will give you 100 units. Your trade did the 100 units. If your trade did what? 50 pips, that means your trade did what? You now say 50 multiplied by what? 10. That will give you 500, because a unit of a pip is what? 10. That means you did 50 multiplied by what? 10 to give you 500. I don't know if you really understand it, but this is the simplest way I can explain this to you so that you understand it very well. So for you to now know how much you will make in the market when your trade does 10 pips, 10 pips, 20 pips, 25 pips, 30 pips, and the rest, how much you make from that market. If you now say, okay, if I enter a trade with 0.01 lot size, 0.01 lot size is a small lot size, and you make 10 pips, what you are going to do is you will say the lot size multiplied by the unit of the pip, and you see what it will give you. So whenever you want to check the amount, you will now say lot size, the lot size you use in trading, multiply it by the unit of what? That pip. Let me say 0.01 multiplied by what? 100 will give you 1. That means if your trade does what? 10 pips and you are using 0.01 lot size, you will make what? $1. Now, if you enter a trade with 0.02 lot size and the trade did 20 pips, what you will do to calculate it is just to say what? 0.02 multiplied by what? 20, multiplied by 200, sorry. That will give you $4. That means you will make $4 when you enter the trade. So what if you enter a trade with what? 0.05 lot size. If you enter a trade with 0.05 lot size and you are able to make 25 what? Pips, that means you now say 0.05 lot size multiplied by the unit of this 25 pips, which is 250 units. That will give you 12.5 US dollar. That's $12.05. $12.05. If you enter a trade with 0.15 and you make 65 what? Pips, what you now do is to multiply 0.15 by the unit of what? 65 pips, which is 650 what? Units. That will give you 97.5. That means $97.05 what? Cents. If you enter a trade with 0.50 and you are able to make 30 pips, you just simply take what? 0.50 multiplied by the unit of the pips, which is what? 300. Then you get what? The amount. 0.50 multiplied by what? 300. That means in that trade you will make $150, 150 USD. Same thing when you use what? One lot size. If you use one lot size, you say 1 multiplied by what? 100. Just making 10 pips. You now see the difference. The difference is if you use 0.01 and you made what? 10 pips, you get $1. If you use one standard lot and you made 10 pips, you get what? $100. So the same thing happens in what? Losses. If you enter a trade with 0.01 and you are able to make 10 pips. Maybe let me say you have a $100 account, and in that $100 account, you know that your risk management, you should be using 0.01 or 0.02 to trade in your account, and you go and use what, one standard loss to trade in your account. If the trade goes in your favor, you are going to make extra $100 in that your account. But if the trade goes against you, you are going to lose what, $100 in that your account. And when you lose $100 in that your account, you have lost your trading account. You don't have any other thing to trade with. That is what poor risk management. Poor risk management is just like 50-50. You are trading. If it goes against you, you are going to lose much. If it goes in your favor, you will gain much. So that is not trading. That is what, pure gambling. So if you are using 1.5 this thing to trade, that you say 1.5 lot size multiplied by the unit of what, the pips you are going to make, 1.5 multiplied by the unit of the pip, which is 500 this thing, you are making 750 USD. 750 USD. Okay, let's look at this risk management from this perspective. If you have $50 to $100 lot size, this is the equity. Equity represents the amount of capital you have in your trading account, in your MT4. That's what we refer to as equity. So if you have $50 to $100 equity, it is advisable for you to be using 0.01 to trade. That's the lot size that is advisable for you to use. And when you are trading, you are not expected to take more than 3 trades. For example, if you are already on a trade on USD CAD, you are on a trade on USD JPY, and you are also on a trade on, let me say, USD ZAR, that's South African Rand. So taking another trade maybe on Euro USD or another trade on GBP USD will now be that you are over leveraging your account. That means you are now taking more than necessary risk. So when you look at, you have an equity of $200 to $500 in your account, and it's advisable for you to take trade using 0.02 to 0.04 lot size. So on this, it's not advisable for you to risk or take more than 3 trades here as well. So if you are taking more than 3 trades, what it means is that you are taking, maybe opening on a position of 0.02, 0.02, 0.02 again. That means you are now using 0.06. That is the idea. If you multiply this thing you are using, if you add up the lot size of any trade you enter, all the trades, that will now be 0.06. So it's not advisable for you to take more than 3 trades. If you are taking more than 3 trades, that means you are now opening yourself up for more risk, which is not healthy for your account. So in that case, if you are on a trade on USD ZAR, USD JPY, or Euro USD, that's the 3 trades already. It's not advisable for you to go on and start opening more trades like the SAU USD, which is gold, the Euro USD, the GBP JPY, and the rest of them. So these are things that you should understand. If you have an equity of $600 to $500, it's very advisable for you to use lot sizes of 0.05 to 0.010. So the idea is for you to be a consistent, profitable trader. It's not that you cannot pack one lot size and use it in an account of $100. No, if you do it, you know that you are reducing the chances of you being sustainable in the market. Let me say, you may be lucky enough to make profit from that trade, but once the trade goes against you, what if a day that you are not that lucky? What it means is that you may end up losing your trading account. Then you go outside to get money to fund back and then start trading and the rest. So it's not advisable. This risk management is a key to profitable trading. So if you have a equity of $1,600 to $5,000, it's advisable you use this lot size and then stick to the number of trades, so that your account, you can also minimize your risk. If you have equity of $5,000 and above, you can use 0.5, 0.8 and one standard lot. So you also have to be careful on the trade that you open. If you open one trade and it's running, you make a profit. Before you open more than what, two trades, three trades or four trades, at least make sure you close one position, make sure you close one running trade, or make sure that one trade is already on profit before you think of what, opening more and more trades. There are some persons that once they open a trade, you see them, they will keep on opening trades, opening trades, opening trades. They will tell you that they are using 0.01 in a $50 account. I see some persons that will use 0.01, open one trade, they will open another trade with 0.01, open another trade with 0.01, and open another trade with 0.0. Before you know it, they have entered like 20 trades or 15 trades with 0.01. That is poor risk management. What it now means is that you are no more using 0.01. You are now using, once you use 0.01 and enter like 10 trades, what it means is that you are now using 0.1. That's 0.10. That is the amount of lot size you are now using, the total amount of lot size, which is not healthy for your account. That's why I say the number of trades also matters. It's not all about sticking to one lot size, advisable lot size. You also maintain a number of trades for you to be profitable. So the goal is for you to be consistently profitable. You have to be very careful with this risk management when you are trading. Risk management is key. A lot of persons lose their capital on daily basis because of poor risk management. So what you have to do is stick to good risk management. Always what, enter the trade when you should enter the trade, and when the trade is doing well, before you open other trades, make sure that you must have gotten done with one particular trade before you start opening up the trade. Maybe because of excitement or because of panic trading. A lot of traders, they panic trade a lot. What I mean by panic trading is you open a position, you look at that trade, it seems that it's going well, maybe the candlestick wants to shoot out. Before you know it, you see yourself opening more and more trades so that you can be profitable, you make the whole money from the forex market. No, forex is not like that. It's one step after the other. Once you trade, you make maybe $10, $20 today. The market is always open. There's still room for you to trade another day. So why forcing to make all the money in a day when there is still room for you to trade and then accumulate the profit that you are making? So don't trade out of excitement, don't trade out of your emotion. Trade with a trading plan. Trade with a trading plan. So in this video, I'm going to also attach in this module a trading plan that you can follow. I'm going to attach a trading plan of $100, $250, $500, $1,000 and the rest, so that if you fund your account, you can say, okay, this is my trading plan. I'm strictly going to follow this trading plan to be making profit. Even if I make $5 in a day, I know, yes, I have made $5. Tomorrow there's still room for me to trade and make money. Not for you to trade out of ignorance, and then you are just trading to make, you make $5 today, you make $15 today. So the trading plan is just to help you to know the direction of where you are going to. You can, in your trading plan, you can trade today and you know that your trading plan says today make $5 and you make like $10 today. Tomorrow you can rest, being that you have made a profit of today and tomorrow. When you don't see setup, you don't force the market, you go and rest, waiting for what, setup. One nice setup can give you a trading profit of 5 days. So that is the essence of what, wealth accumulation, wealth creation. So let's try to follow whatever we learn in this lecture.